Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, November 3rd, 2016. I wanted to do a quick recap, an update. Really not a lot to update. As of last night, I had posted in the post titled "It's Go Time" that the last of the holdouts, the one we were waiting, the leading index, the NASDAQ 100, finally joined all the other indices, which was really only a matter of time. If you have every other major U.S. stock index, the S&P 500, mid caps, small caps, you have the diversified indices like the Wilshire 5000, all breaking down from support, it was pretty obvious that the NASDAQ 100 would have eventually follow suit, and that's what happened. So just to recap, especially if you're new to the site, this is what couple weeks back I had posted as a key level 2011-19 or 2119 on the S&P 500, the red line, and I refer to these as flashpoint or critical support levels. So you can see the selling is really becoming impulsive so far. Straight down, you have a couple big red candlesticks. The S&P has clearly taken that down, and now what it said, how many days in a row? We haven't had a green day in a while. And I had the question put to me in the trading room earlier today, Randy, what are your thoughts on the market? I've made those pretty clear, but I wanted to share this, that I still don't think it's too late for a swing trader to add short exposure. Ideally, the closer you can short to a breakdown. There were short entries I posted even within that 60-minute unofficial short entries on the broad markets, but I've been really focusing on individual stocks lately since the broad markets have been difficult. But for those of you that don't trade individual stocks, especially on the short side, I understand that. For people who are not active traders, are very experienced, you might prefer to stick with ETFs, either sector ETFs or even broad market ETFs. So I just want to make clear that by all accounts, by nearly all metrics I have, the broad markets are now on sell signals that should pan out for corrections that are likely to go on, a correction that's likely to last for at least hard to say exactly how long, but at least a week or more, and possibly several months. And we could be looking at a drop of 15-20% or more from here. But some minimum targets for those of you looking for some near-term targets. 2037 right here is certainly a support level. We may see a reaction on the S&P 500. Might get a little bounce there. Move down to the 1994 area right there. And we'll take a look at the weekly charts here in a minute. But again, I wanted to point out that most importantly, these key support levels have all been taken out, and everything was already discussed. The bearish rising wedge with the divergent high in the S&P 500. All of the U.S. markets had similar uptrend lines, divergent highs, everything you want to see for a short pattern. And most importantly, or one of the most important things, was the recent failed breakout. We broke out to new highs. We took out the 2015 highs, which at that point were all-time highs in the S&P 500. Challenged those. Took a while. We had several attempts to get there again. We went on here, fell a little shy here, a little shy here. Then we broke out. And I believe even before we broke out, most certainly when that breakout was made, I posted comments on the site that my expectation was, my most bullish expectation was for a pullback, not to the 2015 highs, but below there. I had stated that typically when we break out to new highs on a stock or an index, it's been my experience that the back test actually runs a little back below those highs. That tends to shake out a little weak-handed longs that might try to buy that test back to support, might encourage some shorts to jump in there. Maybe the breakout has failed. And I said, at best, we would see then a move up to new highs. But I've maintained the bearish bias all along, and I'll go over that reasoning here. Again, a lot of that has to do with not only what I see on the daily charts, but the weekly charts as well. So there's the S&P 500. Let's take a look at the NASDAQ. Okay, here's the NDX 100. As mentioned yesterday, we had printed a solid close below this critical support. You had the 2015 high right here. You had, an attempt to get in there. We pulled back a little, gapped above it. There was a breakout. We had this one little whipsaw signal back here. And then, as I mentioned, when that happened, we got back up there. I stated that my expectation the next time that we broke down, and the level I was watching, if you recall, that coincided, this support level coincides with, I believe it's 116 on the QQQ. That was that critical level. I was focused on the 60-minute chart. And so when that went, that gave us an objective, actually two objective entries, because we back tested it. I'll get to that in a second. Point being is that we are now, today was additional confirmation. Once in a while, you might get a daily close, which is what I was looking for, and that was our sell signal. That's pretty much what I would call the all-in sell signal. It doesn't get any better than that. Once in a blue moon, they'll fake it out. And central bank might have tried to come in, the Fed, pull some rabbit out of their hat if they have any left. But that didn't happen today. So we're even further below that trend line. Somebody asked, I shared my opinion. I don't, is it possible? Anything's possible in the market, but is it possible to get a back test and short that level? It is, but I don't think it'll happen. From my experience, and it would take me 20 minutes to explain all this, even if I could put it in words. But just from my experience in trading over the years, everything that's happened recently, especially all of these fake outs, as I mentioned, I've had more stops run on my trades personally and the official trades on the site than I can recall in some time. And I've also stated, and I've said this several times over the last few months, it's been those type of periods where you have these, nice setups, whether it's on the long side, whether I'm positioning it for a market turn at the bottom, positioning long, or at the top, where you'll see, the chart pattern setting up bullish or bearish. In this case, it's been bearish. Breakdown, give you clear signals, but then there's another ramp after the breakdown to new highs, and that's that final stop clearing run. And I have my theories on it. I'll try to explain briefly. I think what it does is, it's the final knife through the heart of anybody who's tried to short this market. The bears sort of give up at that point. It run stops. But as you guys know, I'm pretty tenacious. I mentioned when those trades were stopped out that a lot of those would be revisited and maybe added back on as short trades, and I have done that recently. I put on Activision. That one reported today, it traded down as low as 40, 44 in after hours so far, so almost hit the first target there. And there's quite a few other semis and some other trades that I put on. And I did that. It's not out of stubbornness. It's the fact that the technicals clearly remain bearish. I shorted divergent highs and breaks of trend lines when we had that breakdown and some of those stops were hit, and given they were relatively tight stops, I kept things kind of tight, kept the losses up to the small side because of that choppy sideways trading range we were in. I didn't allow a lot of room. And we jumped back into those trades, and many of those we've already recouped the losses, which probably averaged, depends on the trade, maybe a 5% average. Some trades only had a 2-3% loss, some had a little bit more, and we've had quite a few that have, most trades that I do, most swing trades, the gains are measured in double digits, 10, 20, 30% or more, and that's I think we're setting up for a move in the markets that could be comparable for that. So if you can get a 20% drop in the broad market, I can assure you there's a lot of stocks out there that are poised to drop another 30, 40, 50% or more. Again, that's security selection. When you short the broad market, especially something like the S&P 500, you're shorting the good and the bad. You short the SPY, you're shorting utility stocks, all types of defensive issue stocks, high dividend paying stocks, your quote unquote recession proof stocks. Now, they tend to go down if it's a really bad sell off, but they go down a lot less. And that's the reason I have so many individual short trade ideas. Even within a sector. I'll get to that in a second if there's time at the end of the video. I'll talk about the semiconductors and some of the other stocks. So again, where we're at today, just to reiterate, we've broken down. My views that I shared today earlier in the trading room is I don't think that those the longs that are now trapped and starting to realize that, hey, this market is not going to continue to new highs, at least not anytime soon. And the shorts that realize, hey, okay, wow, we really have broken support. I don't see the Fed coming in saving the day. This might be the real deal. And they're probably waiting for a bounce back to those resistance levels. Again, this is just my opinion based on experience. That probably will not come. If it does, that'll be a gift. It'll be a gift because you could short 49.50 or so somewhere back there on the NDX with a stop not too far above, maybe ideally on a closing basis. But If that's your plan, and that's plan A, have plan B. Plan B says that this market doesn't look back from here. And that's my expectation. That's my positioning now. All the support levels have given way. There's not any reason I see not to be short at this point. And again, from my experience, what happens once the market starts to roll over, that selling begins to accelerate, and you can have these very sharp sell-offs. And that's why I think it's still, although it was better to short up here. In fact, let's go back to the QQQ chart that I was talking about. I'll show you that 116 level. Okay, I need to go to 60-minute chart. So here's the QQQ. Forget about all these other lines here. What we're focusing on 116. Again, I've harped on that level for a while. I thought this was a real deal here. It proved to be a false breakdown. We got back above there, and we tested it once again. And I believe all throughout this time I said if and when that level goes, the next time that level goes, and my expectation has all along been that it would, that would be the last time. So from an objective point of view, this was the most objective short entry on the Qs. The first objective short entry was the breakdown, and then you had a second chance on a back test here. And we're talking, yes, the candlesticks went slightly above 116, but if you calculate that in percentage term, you're talking mere basis points. A basis point is 1/100%. So this is, statistically, that is just a simple, that's a back test. Those are 60-minute candles, and we back test that 116 level and then turned that back down. So this is technical analysis 101, folks. You short a break of support, and the next objective, or you don't always get it, another objective entry would be to short a back test of that support level, because broken support then becomes resistance, and you can have your stop set somewhat above there. Again, somebody mentioned the trading room. Is it too late? We're oversold. Oversold, when you look at the RSI readings, that's one of my favorite measure of whether the market is oversold or not. We're certainly below that 30 level, this green line here. And oversold readings, especially when the trend is bullish, and even in this case sideways, they usually lead to rallies. Just as overbought, when you get up to the 70 level, that typically marks tops. My answer to that question was no, I don't think, because the market is oversold, that we're going to bounce. It is possible, certainly is. However, at this point, my focus has turned to the daily time frames. I'm looking at what's gone on here. We've had these series of divergent highs. I have a few different boards. Let me find you another one that makes it a little more clear. NDX. I've got this somewhere. There it is. Well, I don't have the 3 consecutive divergent highs. I think I have that on the S&P 500. This is the chart I already showed you here. So let's look at the S&P 500. Same thing. If I didn't cover this already, there's that flashpoint support 2119. Yeah, I think I already covered that. So we're well below that now. And the other thing I wanted to show you on the S&P 500. Again, this is if you're new to the site. I've been talking about this for months. Was this series of consecutive divergent highs. This was the top back in, remember the S&P topped well before the NASDAQ 100. The NASDAQ 100 was the final holdout. Looked like we topped in mid-August back here. And I was pointing out, we had a similar series of 3 consecutive divergent highs. Now within that, each of those divergent highs, as they almost always do, the divergent highs are big for me. As you guys know, I like to use divergences to confirm market turns. I catch tops and bottoms. I know a lot of people say that's impossible to do. It's not an exact science, but there's big profits to be made. And in every case here, just as every case here, DH1, divergent high 1, divergent high 2, these are corrections, correction 1, correction 2. They have led to corrections. And, do you short a divergent high? We had a divergent high at this point, but we kept going higher. No, what you do is you line it up with trend lines and horizontal support. So once you have a divergent high, that warns you of an impending trend change. And then you zero in, you use a 60-minute charts, a daily charts, you identify horizontal price support levels, trend lines, and other things, and those are your triggers. And so we've had multiple triggers. You can see all the way back here if you really wanted to get in early, and I'm sure this was pointed out before this uptrend line. There's a bearish rising wedge. You could have got in, mere basis points from the high, and you'd still be short. Now, these three consecutive divergent highs, although each resulted in a correction, really form one large divergent high all the way from this point to this point. And you had a heck of a drop that was 15+%. As these three consecutive divergent highs did the same thing. In fact, this might even be a more powerful. It's a little bit steeper. You have some very steep divergences here. And my point being, my expectation is for a correction much larger than we've already had so far. Let's just put it that way. Whether we're going to drop this much, whether we're going to fall more, it's hard to see on the daily charts here. If we zoom out to the weekly charts, you take a look at the big picture, and this shows you this is going back 10 years on a weekly time frame. This is the 2009 low in the markets. The yellow trend line was what I refer to as the primary bull market uptrend line. It was generated off the lows. We broke that all the way back here in 2015. Now, that didn't mark the highs in the market, but it was pretty much the highs. We went up and made only a marginal, meaning a very slightly higher high. And this has been painful. This is a slow roll, what I call. Some market tops, and market tops tend to be that way. Market bottoms, because when you have a correction or bear market, the selling is usually very sharp and impulsive, which is also a reason I love shorting. You can make the same amount of gains in profit, in total profit or percentage terms, in just weeks or even days that takes months or more to make on the long side. And that is because stocks typically fall, as you can see here and here and here and here. You don't see to the left, but that wiped out, that bear market wiped out 50% of the value of the stock market. Stocks typically fall much faster than they rise. So to try to give you an idea where I think this correction may end, these are potential targets. 1992 is support. I don't think that's the final stop. I think at minimum we're going down here to the 1820 level. That's a key support level. And I wouldn't be surprised. In fact, I favor ultimately a breakdown here and a move down to this primary target around 15. That's 1580. Now, what does that mean from where we closed today on the S&P 500? You're talking a drop of about 25%. Will it be a straight line? Almost certainly not. That's why you have these support levels along the way, and you can try to, an active trader can reverse, go long, if the charts confirm. I don't go long on a support just because it's there. And in fact, when you have a major top like this with big corrections, my experience, the first few support levels where people try to step in, the dip buyers or the shorts that want to cover, take the quick profits, those often get sliced through. And then you're left out if you're short. You don't have any more short positions. You don't want to enter if we blast right through there. So I'm just letting you know I don't plan to cover any shorts. In fact, I've been aggressively adding short exposure over the last week and throughout today. And again, if this changes, I went over all those levels, those flashpoint support levels. If we get back above those levels, that starts to change the technical picture. We have no business getting back. Maybe we go to back test, but to see a daily close above, let's say, 2118, especially above, up here on 2130 on the S&P, that will then call things into question. But let's take it one step at a time here. Some targets on the Qs, QQQ, big picture. Again, here's a primary uptrend line that broke down. I had this purple secondary uptrend line, a lot of reactions. Prices broke, back tested, and started to roll over. Here's a minor uptrend line that may or may not come into play, but I'm looking at the move down to the Qs. I see support here, roughly 99.50, call it maybe 100, 92, and ultimately I think a move down to 83, 50, 84, somewhere in there is very likely, and that would constitute a drop of about 27%, and that meshes with that downside, target I said about 25 or so on the S&P 500. The Qs are a higher beta index, and they go up more, and there's a little more hot air in these stocks right now. So again, and they don't have a lot of dividend paying and defensive issue stocks like the S&P. So in a bear market, you usually get more bang for your buck shorting the Qs or the small caps, then you do the S&P 500, and vice versa in a bull market. Strong bull market, the Nasdaq 100 and all those tech-heavy companies will go up more than the steady Eddie dividend payers. Okay, quick follow-up to the recent post on the a phenomena or a pattern, I should say, that I've followed for years. Talked about this for the last several years on the site. It's what I refer to as the OPEX ramp and subsequent fade. What I mean by that, OPEX is short for options expiration. Now, there's many different options that expire at different times, but they're standard options on the stock market and stock indexes expire the third Friday of every month, and that's what the red lines here indicate. So you can see the last options expiration was October 21st, and September 16th, etc. So the dotted lines, and again, you can reference this post. It was made back on October 12th. FYI, if you go to the very upper right-hand corner of the site, there's a little plus bar in the uppermost right-hand corner. Click that. It'll drop a menu down. You can access a calendar to pull archives and things. And this is also under market analysis. So back here on October 12th, I think it was this candle right here, if I'm not mistaken. I said my expectation was for a ramp into OPEX. That's been the typical pattern. There were a few. The circles indicated a few times we didn't get it. Those typically come after big drops. So like every other pattern in the market or any tool that you use, nothing plays out 100% of the time. If it did, it either wouldn't work if everybody knew about it, or if anybody knew about it, they'd have to keep it a tight secret because it would get out there. So I can just tell you nothing's 100%. But again, it's a pattern that more often than not has played out with ramps leading up into options expiration, followed by a sell-off shortly thereafter. Again, the circles, it didn't happen, but there's the OPEX ramp. And as I said, usually within a week or so, you get the fade. Sometimes it's immediate, sometimes it takes up to a week. And as I mentioned, after very large corrections, if you didn't have a ramp leading at OPEX as you did here, you're not going to have a fade. So on the periods where you get a ramp into OPEX, and you can see the white arrows show the fades are pretty consistent. So pretty consistent pattern. This one you didn't really ramp up. You had a 2-day pop. You still had a fade anyways. And there was a fade, a hair higher, but that played out for a pretty good correction. And again, this one, the arrow's not there, but the very day after, it looks like the day after options expiration, we've done nothing but fade. You can see all the red candlesticks. And how much more downside to go, that's yet to be seen, but I just wanted to point out that so far so good on that OPEX fade. It's certainly in play. And I even did a follow-up post, I believe, the day after options expiration or a couple days later, that the OPEX fade, the ramp fade, following the ramp into the final week or so of OPEX, the fade was in play. Okay, some final notes, where to make money, how to profit. If you agree with my analysis, like everything, I can be wrong, I can and will be wrong at times, and that's what stops are for. Whether you're long, short, bullish, bearish, no matter what you're trading, all you can do is look for objective setups, wait patiently, wait for the most attractive looking setups, and then when you see your buy signal, don't second guess it. Go ahead and put on your trade, long or short. This is SMH, as I've mentioned for weeks now, one of my favorite sectors. This is the one, since I've had so many trades, we saw quite a few stop raids on these, but they've panned out. On balance, the trades are all profitable. Those that were stopped out, I've already added a couple back officially, like Activision, which today was down after hours on earnings. So that one actually came real close to the first target so far in after hours trading. And I have, a very high degree of confidence that first target and then some will be hit. But I wanted to point something out. So here's the semiconductor sector, which is one of my favorite. SMH, as well as the 3-time leverage ETF, SOXL. That was the official alternative. You can either go short the SMH, short XOXL. You can go long SOXS, but I talk about decay. I'm not a big fan of buying 3-time leverage ETFs. I like to short them, even if I want long exposure. So pointed out recently that we had this bearish rising wedge with a divergent top breakdown. Then we had this little flagging pattern. We have since broken down, This really opens up the door for a move down to that minimum first target of 62.64. And just as every other divergent high in the past, I talk about divergent tops. They are a very good indicator, especially when combined with these breakdowns. You can see the trend line, breakdown, backtest, just as we recently had. Breakdown, a high level backtest, and then boom, it played out. Another divergent top played out for a correction. Based on the scope of this divergence and everything else I'm seeing in the market, the deterioration of market breadth, the long-standing bearish developments, the near-term bearish developments, I see no reason that this trade won't go on to hit this final target. And you can always, if you're holding out for the longer-term targets, you can just lower your stops as you go or trail a stop down. Give it a little room. There'll be some volatility in a sector like the semis, but I just wanted to point out that is one of my favorites. And keep in mind, if you're shorting the broad markets, if you're shorting the Qs, the NASDAQ is a very tech-heavy index, and semiconductors they lead the tech industry, and they are part of a subsector of the technology industry. So XLK, let's just take a look at that. Here's the tech ETF. So if you're short XLK and you're short QQQ, you have a lot of overlap. Just be aware of that. And that's what I keep talking about. I have a lot of individual semiconductor stock trades out as well as a semi ETFs. I pointed out XLK so far, breakdown, ramped up, tried to match those previous highs and has rolled over since. So this is a minimum target, about 45.90, give or take. These aren't official. That's not an official trade idea. That's the actual support, 44.82, which is where that would be my preferred target right now for XLK. And again, you can see the negative divergence down there. Again, just be aware that if you're trading the semis or you're trading the Qs or all of the above, that you have a lot of overlap. Just one other thing on the semi sector. This is another semiconductor ETF, SOXX. And you can see nice bearish rising wedge, breakdown, backtest. Textbook. And usually what happens after a wedge breakdown and backtest, if and when, which I expect, we take out these recent lows after the breakdown, this is where the impulsive selling gets in. So I don't expect this one to limp all the way down here to this target. If and when that level goes, which my guess is it'll happen probably within the next week or so, we'll get a quick move down to this level. That's about another 6.5% drop in the semis, and ultimately I would expect a reaction there. May or may not happen. Ultimately a move down here to about the $97 level, and for that would correlate to a drop in the semis of about 12% or so. Now, one reason I trade the individual names is let's see, here's a good example. When I did the semiconductor video, I did one or two in recent months. I pointed out Cypress as a nice shorting candidate. There was a bearish rising wedge. I really can't recall if I pointed out before the wedge broke down or right after. But as you can see, this played out, pretty much textbook. We had an initial thrust down, hit my first target right here. As I often talk about, I list targets because that's an area I expect. It's a significant support level where I expect a reaction, meaning a pause, a consolidation or a bounce. And that's exactly what happened right around that first target level. And then once the first target level goes or that support level goes, you had a continued move down. So another way to look at this, it looks like a flag pattern. You have a flagpole, an impulsive move down, a consolidation, which is all a bear flag pattern or bearish pennant is. And then the flag broke down and it hit the target. And there's somewhere else I'm going with this example here, guys. If you take a bearish rising wedge or even a bullish falling wedge, the easiest rule, you can get online and there's all kinds of formulas to get a measured price target for a chart pattern. The simplest and what I find most effective is just take the widest part of the wedge, which I'm doing here, and add that to the point at which the wedge breaks down. In which case this is very close to my target. There's actually another level right here. So I wouldn't be surprised to see Cypress go down to this level. But it had hit that support, that final target I had, and it was up 1.34% today. And so was the, let's see, well, the semis were down as a whole, 0.42, not a whole lot, but when I go through some of the individual names that I covered in the video recently, there's Intel, 2%, Taiwan Semi, 0.3, Texas Instrument just broke down from this bearish rising wedge, 1.37. Nvidia, which you guys know is one that I like and I'm personally short. That's one we got stopped out and added back, I believe, 1.16. So you get the point. If you can go through and pick out the most bearish sectors, here's another one. This is also an official trade idea on the site, semiconductor, and quite profitable. We're close to the first target, down 2.4%. So just as I said, by shorting the S&P 500 and using that example, you're shorting the good with the bad. Even trading a bearish sector like the semis, I find that I can do better by shorting the most bearish patterns and avoiding the most bullish patterns, and often outperform the sector as a whole. But I trade full time. I have the time to sit here in front of the computer and manage these positions. Some of you don't. If that's the case, stick with the ETFs, or you can trade these and just make sure you have stops in place. Limit orders, good to cancel so you don't have to be in front of the computer. That way, if your target gets hit while you're at work or away, the order will fill. Okay, guys, this video has gone a little longer than I thought it would, so I'm going to just go over a couple other things. I've mentioned there's some sectors that other sectors that I'm short and bearish, and we have trade ideas on the site. The casinos and resorts sector, now the closest thing I can find to an ETF that holds some casino and resort stocks is PEJ. There may be another one out there. So again, if you prefer sector ETFs versus the individual names, then you have PEJ, and you can see on that one, you can see what we have here is a bearish rising wedge pattern, which just broke down today. You can see the breakdown, pretty impulsive. So there's your sell signal. And as, if not more importantly, you had this well-defined downtrend line with, I shouldn't say well-defined. There were a few hits, but it was pretty clean. And we had a breakout recently. On face value, that's bullish, but I often talk about this. In trading, fewer things are more bearish than a failed long side breakout, just as fewer things are more bullish than a failed breakdown. When you're watching, if you were watching a key support level, that happened with the mining stocks. I pointed that out back in early January before it even happened. I anticipated a break below, I think it was a 13 level. You can look at the videos from early January, and said I could see a bear trap scenario where we drop below 13 and then boom, have an explosive rally to the upside. And that's exactly what happened. That 13 level, if you go back, look at GDX, again, I think it was 13, very well defined, and then boom, that's what happened. So here's another one. If you have a little more diversity, or you can pick the individual casinos like I've talked about. There's a whole bunch of them. Again, go reference the video. There's ISLE, it's playing out for a drop. There's quite a few. I think there's one that even reported tonight. Yeah, that was ERI. ERI was, I can't recall. Again, it was in the casino video. I said that was titled betting against the house, shorting the casinos, or something to that effect. I think that was only a week or so ago. And this was ERI. So it broke down. This was a support level. And so far, since it's taken out that support, that one's dropped, over 18%. And again, you can take the individual names. Just be careful because we're still in earnings season. If you diversify enough and you're shorting or going long the most bearish or bullish chart patterns, like I always say, on balance, the gaps, earnings-induced gaps tend to go your way. But again, that's on balance. So if you don't have a large enough portfolio to diversify among many names, spread out your eggs, don't put all your eggs in one basket, then you can do that. Otherwise, stick with the ETFs because you can really get burned on just one or two positions going against you, a bad gap against your position. I'll leave it here, guys, because this video has run longer than I thought. And I'll continue to update any attractive trade ops, as well as some longs. I have a couple things I'm looking at maybe on the long side. There's always something that goes up even if the market goes down. So I'll try to follow up with those soon. This has been Randy Finney with Right Side of the Chart, and I hope you enjoyed it.